over the coming several years, whether it's 2, 5, or 10, is going to be in a hyper bull market. Again, keep in mind, it needs to rally 300% just to get to the global marginal cash cost of production. That's a pretty significant move. Keep in mind that back before Fukushima, prices touched as high as $140 a pound, again with spot prices now in the $20 per pound range. So there's enormous scope for upside, driven again by deficits in the market, because utilities will pay any price necessary once there is a dearth of supply, and they will not be opportunistic buyers on the other side, meaning that prices can almost go to zero if they don't need material. Again, if you ask me to kind of segment it, I think in the very near term here, on the back of the McArthur River mine shutdown, we should start trending back to where the world's low-cost producers are willing to sell material. And that's around $45 or $50 a pound by our estimates. So a more than doubling of the spot price from here, and that's in the near term. In every subsequent year going forward, the deficit is going to increase because demand, based on reactors that are already under construction, is going through a growth phase, and there is no new supply that can come on in short periods of time to meet it. Again, given the lead time that it takes to bring a new mine online. So as we get into a more and more heavily undersupplied market, prices will rise, in our opinion, more and more radically to incentivize higher and higher cost and more marginal projects to come online. And again, it's kind of basic economics that the higher the return potential, the more incentivized an economic actor is to invest. There's been zero incentive to invest. We need very, very high prices to incentivize as much investment as possible to fill what we think is going to approach a 30 or 40 million pound deficit in a 200 million pound market.